In illustration number 9, what we had to do? Prepare plant account, accumulated depreciation account, and plant disposal account, assuming that the company closes its books on 31st December every year. So calendar year is adapted. So the first purchase happens on January 1, 2012 by Jane and Son, purchased a second-hand plant. And finally it is destroyed by fire on July 31st, 2015. It is not sold, but anyhow, as it's lost in fire accident, it might have been insured. That's why this company gets the insurance claim for the loss. So receiving the insurance claim is equated with the sales realization. You assume that the asset is sold and you get the money. No. Same way, when the asset got destroyed, where it was already insured, then any insurance claim is received is equivalent to sale consideration received. So we have to now prepare the accounts since the date of purchase to the date of disposal. And here the asset is passed through, sold or disposed through plant disposal account. So in case of plant disposal, what do you do? Transfer the asset disposed at the original value to the asset disposal account, as well as the accumulated depreciation on the asset sold up to the date of sale should also be transferable. So these two you have to understand. Now, plant account, and provision for depreciation account, Finally, we have to prepare asset disposal or plant disposal account. Is that okay? Now, acquisition happens on 1st January 2012. A second-hand plant. If you purchase any second-hand asset, to bring it to working condition, any expenses you incur like repairs and renewal or any other installation charges, a test run and all will be forming part of the assets value only. Should be accumulated that all the value put together the assets value, right? So here plant costing rupees 2 lakhs and spent rupees 10,000 on its overhauling. It also spent 5,000 rupees on transportation and installation of the plant. So all the three values, the cost of acquisition of the second-hand plant and overhauling expenses 10,000 rupees and transportation and installation 5,000, all the value put together, it comes around 2 lakhs 15,000. This is the value of the asset also. Right. On 1st January 12, plant account debit to what? Bank. The value being 2 lakhs 15,000. Okay. It was depreciated to provide for depreciation at the rate of 20%. That too on written down value method. So we have to adapt written down value method. Under written down value method, every year you are going to calculate the depreciation based on the WDV value. WDV value is nothing but original value minus amount of depreciation already charged. Whatever the leftover amount of the assets after the depreciation will be called as WDV. On that, this 20% will be applicable. The plant was destroyed by fire on 31st July. So up to 2014, we just repeat as usual. So there will not be any change in the value of the plant up to the date of sale because we are going to follow the provision for depreciation. Any depreciation is there will not be adjusted in the plant account. So the plant account remains the same year after year. So the first year end 31/12/12 by what? Balance 2 lakhs 15,000. This becomes as an opening balance the next year 1/1/13 to balance 2 lakhs 15,000. By that year end 13 by balance, by the time also the value is the same 2 lakhs 15,000. Next year 1/1/14 to balance 2 lakhs 15,000. By the year end 31 2014 by balance 2,15,000. Now from 1,115, no, so to balance brought down 2,15,000. In this year, halfway through, the asset was sold on July 31st, 2015. On sale, the asset at the original value will be transferable from the assets account to asset disposal account. So I will be posting that now. The disposal happens on 31st July 2015 by asset disposal account, AD account in short I use, right, 2,15,000. Thereafter, the balance of the plant and machinery will be 0, nothing will appear. This value is transferred to the plant disposal account. The date of transfer being 31/7/15 to plant account. The value being 2,15,000. This will be plant disposal account also. And the provision for depreciation. In the very first year, we have to create the depreciation. First year end only we will be charging the depreciation. So 31/12/12 by depreciation. The rate of depreciation in this case is 20%. So we have to provide the depreciation 20% on this. 43,000. Hope so. You could not understand. So it's 43,000. Now if I tally this, you will get the same 43,000 as the balance on the same date. 31/12/12 balance brought down. Okay, to balance brought down 43,000. This becomes the opening one for the next year. 1/1/13. Yeah, any doubts? By balance 43,000. In the second year end 31/12/13 depreciation supposed to be provided. I'll just use a working note here. Original value on 1/1/2012 being 2,15,000. As per the WDV model, depreciation for the year 2012, 20% on this being 43,000. After subtracting the value, what you have is nothing but WDV as on 31/12/12. Yeah, come on, tell me the value. 1,72,000. And second year depreciation, the depreciation for the year 2013, 20% on 1,72,000, 34,400. So 34,400. After subtracting the WDV here being 1,37,600. This happens on 31/12/13. Okay. Now we have to provide the depreciation for the next year 2013. This is 12/13. 2014, no? For the year 2014, 27,520. Yeah. After that, the WDV on 31/12/14 being, yes, 1 lakh minus depreciation should be subtracted. 1,10,080. Now the last year depreciation will be provided up to the date of sale. The date of sale happens on 31/7/15. Half 7 months depreciation to be provided, right? So 1,10,080 into the rate of depreciation being 20%. Now the period for which we supposed to calculate is 7 months only. So into 7/12. What is the ultimate value? 12,000. Okay. 12,843. Am I right? 843. Okay. Now here I'll just Post all these things in provision for depreciation, 43 is over. Second year, 34, 400. If I total this, what is the total depreciation? 77,400. 77,400. On 31, 12, 13, the balance now being 77,400. Next year, 1, 14, opening balance being 77,400. And for that year end, 31, 12, 14, you have to provide the depreciation, which is 27,520. Already we have found out that in the working note. So 27,520. If I add this, the final value being 1,04,920. 1,04,920. That becomes the balance here. 31, 12, 14. The balance being 1,04,920. Next period, 1, 1, 15. The balance being 1,04,920. And in this year, halfway through, one of the assets sold. Up to the date of sale, we have to charge the depreciation here. So 31, 715. Depreciation here being for the 7 months, 12,843. Now if you total this, the total value being 1,17,763. Okay. Now, whenever the asset sold, automatically the accumulated depreciation on the asset sold will be transferable to plant disposal account. That asset disposal account, 1,17,763. That goes to the plant disposal account in the credit side. So on the same date, 31/7/15, provision for depreciation. This value being 1,17,763. And finally, the provision for depreciation is closed. No more provision is required as the asset is already destroyed. And plant is also 0. Now, how much compensation we received here? We have received compensation of rupees 50,000. Either it may be received or it may be assumed to be outstanding. But here it is admitted by insurance company. They have accepted to pay, as such now not paid. So then automatically it becomes a due. So insurance claim account debit to plant disposal. Due entry, party's name will come. So I'll use the insurance claim account here. Insurance claim. If we have collected this money, no problem. If we could have collected, then we can directly name this being bank. Here, not yet collected. So this value being 50,000. This value being 50,000 rupees. And tally this and find out if there is any profit or loss due to fire accident. Of course, there is a loss. So loss on fire accident. Loss on fire accident. Is that okay? Loss on fire. Balancing figure. So 2,15,000. 2,15,000. The balancing figure here being 47,000. 47,237. 237. Is that okay? Come on, make a note of it.